GM, welcome to another Touchgrass podcast episode. Although our guests this week are investment partners of a registered investment advisor, any comments on industry performance are opinions and not guarantees. Nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice. Today we have the partners from Multicoin. Obviously, early February, Shayon, Tushar, Spencer, everyone at the Multicoin team posted a pretty grand thesis. It took me and KG probably 3 or 4 days to go through it. It took us another 3 or 4 days to ask the team to come on, and we're finally making it happen, guys. Welcome to the show.
Thank you for having us.
Thanks so much for having
Awesome.
us, guys. Excited to catch up.
I think sort of, when we asked our audience like what kind of questions we want to ask you guys, the first most common question that popped up was what sort of goes into writing these theses? Like Shayon, do you, Spencer, have like separate theses and then you sort of bring them together? Like talk us through like what generally a fund goes through when writing such a comprehensive piece.
Yeah, happy to. Well, I'd say the first thing I'll say is, on the thesis that we put out a couple of weeks ago, that was a fairly large endeavor, given that it's been a little over 6 years since we've presented a formal update to the lens with which we're assessing the market. And so, that document that you're referring to is really the culmination of a lot of the work we've done through our investing, through our thinking over the last, 6 years or so. And it's really more an attempt to kind of, hone in on what we think are some of the more definable, concrete opportunities in crypto and crypto capital markets right now. So we can, call our shot and identify our strike zones over the coming years. I will caveat that I don't think that these are fully exhaustive, right? We're always surprised by founders. We're always surprised by entrepreneurs who are taking swings and bringing us ideas and things that we haven't thought of before, and there's like a huge component of that. But I think what that doc is a distillation of a lot of the core themes that we have seen kind of like compound and continue to progress as sort of the infrastructure around what we think of as crypto today has evolved. And so I'm happy to kind of go through each of those individual points if it's helpful, but for the sake of time, the process and I think, and Spencer, correct me if I'm wrong, but like I think the way that thesis construction generally occurs at Multicoin is, we try to identify markets that we think are large and unexplored, and in conversations with founders that are exploring those markets, and trying to reason about them, we it's a combination of like discussions with them and discussions internally that we try to arrive at some notion of truth around what has staying power, what has durability, why this business from first principles or this specific take on this type of business can become a durable compounding thing. And I think really it's a lot of it is just back and forth between us on the team, like reasoning about individual companies or individual markets, and then over time distilling that into like a concrete idea or what we would hope to consider a differentiated view on a market structure. And I think once that is done, depending on whether or not it's cogent enough to publish into the world, we get started on putting it into paper, and that'll either be Spencer outlining and putting a bunch of his thoughts, and then me reviewing, or vice versa. And we'll throw the ball to everyone else on the investment team. We'll share it with our founders. We'll get more ideas, and then when we feel like we have something interesting to say, we put it out into the world. And I say that's the bulk of how we've done a lot of our blog posts so far. And I think the broad thesis doc was just like a grander version of that, which is taking like a more exhaustive view on the market, thinking about what's worked and what we're excited about.
Yeah, I think it's awesome to see sort of Multicoin put out all these comprehensive pieces. Like I've been following sort of the past 2 blogs as well, extremely well written. At least like they give you something to think about, especially in these markets where nothing's really happening. So you tend to think more about the future view. Before we sort of get into like the individual themes of the thesis, Spencer, Shayon, do you guys want to talk a little bit about, what's sort of the shift we're seeing from like, the 2 crypto eras? Like I would say 18 to 24 was the era, and then we're in this sort of newer era now. What's sort of the shift, and how are you guys approaching it?
Yeah, happy to take this one. So, I mean, we published our first, investment thesis back in 2019. And in that, we called it Crypto Mega Theses. And we outlined, three basically visions for how we thought crypto was going to compound for the next decade. The first one was global state-free money. The second one was open finance, which is kind of like a superset of DeFi. And the third one was Web3. Candidly, I think two of the three have played out, right? Like DeFi went from under $1 billion of TVL at the time to, I don't know what the latest number is, but I think it was 120 billion or something like that now. And stablecoins went from, also under $1 billion to something like 320 billion now. I think the state-free money one is particularly interesting because, when we wrote about it back in 2019, a lot of people kind of thought it was like a fringe libertarian and gold bug thing, and nobody really cared about it. Since that time, though, the US, they froze Russia's FX reserves. They started, weaponizing the dollar. There was a ton of money printing. And so I think the idea of a global state-free money has, kind of come to the forefront, and a lot more people are actually interested in it. I think, what's changed, though, is I think on the Web3 side, we were very excited back then about things like, decentralized storage, decentralized social, decentralized compute, a lot of things that don't really touch finance or payments. I think, we've seen a lot of protocols building in that space struggle to find product market fit, particularly, compared to ones that are focused on things like trading and payments. I think if you look at the token terminal data, like 19 of the 20 top generating protocols in crypto over the last year are, either stablecoin related or finance related. And so this most recent attempt at a thesis was us trying to distill, why we believe that blockchains are fundamentally from first principles the correct technology for finance and payments. And so I think that's probably the biggest thing that's changed since 2019 for us.
100%. I think everyone pretty much has come to this consensus of, blockchains are made for finance, they're made for money movements, payments and trading. That's what, crypto is all about. Everyone, we've invested, I think, billions of dollars went into gaming, it went into NFTs and stuff. I mean, and nothing has kind of was sustainable. So I think everyone is kind of just doubling down on what's working. But I want to understand, right? Like, for the past couple of years, we've seen a lot of apps. I mean, obviously Polymarket and others. But before that, we saw a ton of investment into all the infra plays, right? And in your opinion, do you think like the infrastructure trade is over and everyone should just be focusing on apps, or what's left in the infra stack? Is the middleware with bridges and aggregators? Is that part should get better, or there'll be more and more blockchains as well in the coming years?
Yeah, I like how you segment it out, because I think homogenizing infrastructure is generally the wrong way to look at things, right? Like I do think that the 2017, 2018 era, pure L1 or L2 trade is probably generally over. I think at this point, block space is pretty commoditized, and, being fast and cheap as a base layer is kind of table stakes now. So I think generally if someone pitches us, or honestly, I think most of our peers, a new L1 today, and the whole story is just performance, it's probably going to be a pretty tough sell. Infra itself, though, I don't think it's dead. It's just moving up the stack, as you were alluding to, right? Like there's a lot of, what we call DeFi middleware companies now that basically let fintechs plug into DeFi rails on the back end and expose it to their users. And, we've invested in a handful of companies building in the space like, LeFi and Fund.xyz and Yield.xyz. There's still a lot of wood to chop as well on like the actual on-chain execution side, right? So candidly, on-chain market microstructure today is honestly pretty bad. And that, that's not exclusive to just Ethereum where, block times are slow. It's kind of applicable to everything. And so, there's a lot of different companies working on things like order flow segmentation or private routing, or, making the mempool, private. There's also probably an opportunity still to build infra for stablecoins. So things like, compliance and identity. And so, yeah, I do think that like infra, as we've known it in the past, which basically means block space, like that trade is probably over, but there probably are still a lot of opportunities up the stack from that.
Awesome. Shayon, any thoughts on that?
Yeah, I mean, I would say that we've had a ton of attempts at like what you would consider like some of the foundational primitives around. If you believe the thesis that crypto is about money, it's about payments and trading, and the form in which it shows up is creating new markets. And I think like that sentence in of itself kind of like captures a lot of kind of all of like a lot of the applications and the infrastructure underneath it. If you think of the rails that have been built around each step, on ramps, self-custody, transaction signing, all of the small component pieces, that infrastructure has just monotonically gotten better over the last 7 years, but there's no reason to think that it's going to stop, right? Like it's easier to on-ramp into crypto today than it was 7 years ago, but the on-ramp rates are still miserable. Like I think if you look at most apps, it's like sub 3% conversion, right? If you want the KYC on chain or like, try and have shielded, have like gated access to certain assets, there still isn't like a clean standard that you and I can name that is going to guide that, right? If you want to do private swaps, right, there's no clear winner in terms of the standard on that. And so I think there's like a ton of low-hanging fruit still to like build best-in-class consumer experience for all of these things, and those things will improve and mature and compound. And look, maybe they're entirely new players, maybe they're existing players that are improving. But I would say like if the question is like, is all of the infra completely mature and you can stop? I think the answer to that is no. And there's going to need to be a lot more work there.
Got it. As you're kind of figuring out what's next, why don't we kind of get started with the multi-coin thesis that you guys have recently published? There are 8 main themes. Before we get into that, kind of, can you explain like what's the high level on like about the entire thesis, and then we can kind of get into some of our favorite themes of the paper.
And I also want to ask, like, do you guys have individual particular favorite themes yourselves, or is it more everyone's bullish on everything?
Yeah, look, I'll say that the overarching thesis is that public blockchains are the first principles correct technology for moving money. And that means that you can coordinate capital and resources and ultimately power financial markets in a much better way than you would over traditional rails. I think that's like the one line distillation of like how we think of the opportunity for crypto. In terms of individual theses, like I think every investor in Multicoin is broadly excited about all of these themes, but they have, as you mentioned, like certain soft spots. I spend a lot of time thinking about the capital formation and resource aggregation side of things. So things like DePins and the labor markets. I don't think anyone should be short the broader trend of entertainment finance, which is this idea that young people are spending more time thinking of trading and moving money around as a form of entertainment. I think the core cryptographic primitives that essentially brought us, like, people forget that like the foundational substrate of all this technology is cryptography, and cryptography can be used in a bunch of really meaningful ways as we try and scale these core systems for moving money around, but also interact in a world where there are more bots and quote unquote AI agents than humans, and the importance of verification and identity is going to matter a lot more. And so I'd say, yeah, we're all excited about all of these themes, but yeah, I think there are certain pockets that I'm potentially more excited than Spencer about, and vice versa.
Well, ironically, we didn't do this intentionally, but if you kind of list them out, all 8, I think I probably spend more time on bullet points 1 through 4, and Shayon spends a lot more time than me on 5 through 8. And we didn't actually do that intentionally. I think it just kind of happened.
And then Spencer, do you want to name some of the themes that you're a little bit more excited about?
Yeah, for sure. So, I mean, I guess I can just go in order. The first one we talk about is Fintech 4.0. And I actually wrote a blog post a few months ago, like before we published this thesis post, called Specialized Stablecoin Fintechs. And the claim I make in that post, as well as, I guess, as in this first thesis, is if you look at the history of fintech, right, there's been, in our view, 3 eras, and now we're in era 4. But era 1 was bringing finance online. So companies like PayPal and E-Trade. Fintech era 2.0 was neobanks. So, Revolut and Robinhood and Nubank basically built like specific products for specific customer cohorts. Phase 3 was the embedded banking era. So, basically putting finance into everyday apps that you use, whether it be Uber or Lyft or DoorDash or something else. And I think we're now entering what we're calling Fintech 4.0, which is a stablecoin and permissionless finance era. And what's really cool about stablecoins and permissionless finance is, like, if you look at the fintech stack today, right? Like, in order to build a real fintech, you probably need, a list of about, call it like 15 to 25 vendors underneath, right? You also sit on top of slow banking infrastructure and the card networks, and like all of these intermediaries are taking massive cuts. And so what happens is, like, you might generate, for every $10 of value you generate, you might only capture $2.50 or $3 worth of the value. Whereas on stablecoin rails, because you get rid of this huge stack of vendors, you can keep more margins. And so what this enables is, again, what we're calling specialized stablecoin fintechs, where, we're kind of going back to the neobanking era, where you can build extremely targeted products for specific user cohorts. So, you can build an app specifically for freelancers, but only in LATAM, or you can build a product for K-pop creators, and like maybe there's only 25,000, people in your total addressable market, but because your margins are so good and your customer acquisition costs are probably much lower because you're serving a very small group of people that all know each other, you can actually build venture scalable businesses with, just like one product that serves one type of user. And so, we've been looking at a lot of these specialized stablecoin fintechs, and obviously we want to back some of them. We've also, invested in things that are collapsing that fintech stack that I was talking about before. So, Squads is a good example with their Altitude product. And then, like P2P.me and Eldorado are some other examples. But that's probably the thesis I'm most excited about of the 8.
Yeah. And as we are already on stablecoins, I think this agents using crypto as a rails for their cross payments between agents has been a big kind of topic over the past couple of weeks. I mean, maybe because of the Citrini article. But how much of that is a part of your investment thesis when it comes to stablecoins? Because we are going to a place where agents will be all over the place, and they'll kind of handle these payments for us. And is that part of the how you kind of are investing as well? Or yeah, just in terms of like how agents and stablecoins play a role?
Yeah, look, I think we've been hearing sort of this broad claim that agents are going to use crypto to transact across the internet because it's like natively built for them. This is an idea that's been sort of circulated since people were saying the word agents. And I think I'm in broad agreement that that is how the world will net out, not less because agents can't use bank accounts, but like for the same reason that it's better for humans to use stablecoins than it is to use like send a wire, right? So agents, it is strictly easier and better for, internet native, digital native beings to use these rails to transact. I'll say that there's been a ton of experimentation around what that standard looks like. I think some of the work around X402 and different MCP servers and configurations of like trying to hook up payments to these to these agents. I don't think we've seen a clear winner here. I mean, the layers here start from as small as like a 3-person team trying to like build a simple wrapper over transaction signing and key generation on Solana, all the way to I think the teams at Cloudflare are working on a new payment standard. I think in they're working with the Coinbase team to try and build that out. And so we're in this moment where the standard has not really been set, and there's just going to be a lot more experimentation. But I'd say the bigger bottleneck is more around the capabilities of these agents. And a year ago, most agents were like pretty bad at using like the desktop and running into walls and having a ton of trouble interacting with the internet. I actually wrote a piece called "Inverting the Human Agent Relationship" about a year ago, talking about exactly this, which is this idea of having certain agents coordinate human labor because that's what they need in order to improve on a capabilities perspective. And the way that you get that human labor is by paying people out in either stablecoins or new assets. And I think the first real instantiation of that was post Claudebot, this like rentahuman.ai marketplace, which I don't know if you guys saw. So it was pretty wild to see like almost exactly 1 year later, that thesis, at least in its earliest form, playing out. So look, I think it's definitely going to happen. I don't think we can be too prescriptive about exactly how that works or like which standard wins. But I think from an investment perspective, the way you go along stablecoins is through the rails underneath them, right? Like you can't buy USDC and hope to go long stablecoins. You invest in the borrow lend protocol surrounding it, the ancillary infrastructure around moving it. Maybe you look at some of the issuers if they're particularly specialized, right? So there's a bunch of different ways that we've played that thesis, but I don't think you can really discriminate in terms of like a human's going to use this or an agent's going to use this. I think everyone in the world is going to use stablecoins, and that's the trend we're along.
Yeah, I think there was also this instance of this AI agent company trying to hire a human CEO. I thought that was pretty funny. I think we'll see a lot more of these. Shayon, talking about things on the internet, you talked about the entertainment finance piece. This trend of, we saw Mr. Beast also trying to get into this through like the bank that he acquired. Can you talk to us a little bit about, what entertainment finance means from you guys from an investing point of view? Like, is this more like TikTok style prediction market stuff that we've been seeing vibe coded on the timeline? What does this thesis mean, and how are you guys approaching it?
Yeah, I look, I think this is one of the like kind of broader societal trends that has been in the works for the last 20 years, really. And I think the right way to frame it is to just sort of examine the attention patterns of younger and younger generations, which is a generally shortening attention span, a desire for outcomes and stimulus and movement very, very quickly. And that combined with the fact that the capital markets, the economic machine, even today, and this is certainly going to be exacerbated by AI, isn't really serving younger generations in the way that it used to, right? Like there used to be this promise of, an American dream where you could, work a job and, if you stuck to the social contract, you'd be able to buy a house and send your children to college, right? And it just, the shape of the economy as it stands today does not give you that. And so the natural kind of implication of that is more and more young people are spending time in playing new games in new capital markets to try and achieve the goals that they would traditionally spread out over a 30 or 40 year career in a just much more accelerated time frame. And so this looks like everything from meme coin trading to sports betting to prediction markets on whether someone is mentioning a certain phrase on an earnings call. These are all instantiations of like that same instinct that is, I think, universal and growing, and it's a very hard trend to fight against. And the reason we see crypto and crypto primitives as playing an important role in that is the market structure for a lot of these types of venues is just fundamentally broken. So if you look at the way a sports book is constructed, it is it is in almost every single way stacked against the end taker, which is, if someone is a particularly sharp sports bettor or playing too well, they will immediately get banned by the large casinos. They are restricted from service in certain regions and not. In general, the spreads are much wider because they're trading against one counterparty, which is the house. And so, sports prediction markets are a first order correct solution to solving that problem. I think that when you think about the types of games that people play, a US equity with a 10 or 15 vol is just frankly not that interesting, right? The marginal 21-year-old is looking to trade a 300 vol asset, or take a 15 vol asset and trade it with so much leverage that it starts to look like a 300 vol asset, right? And if you just kind of examine it from first principles, if crypto is about infrastructure to create new markets and allow anyone to permissionlessly create new markets, I think that as people try to figure out the exact behaviors, the exact instincts to serve this demand that I'm talking about, they will build those markets on crypto rails, because the cost of building those markets on crypto rails is much lower than it is via traditional rails. Getting licensure, acquiring a money transmitter license, getting, there's the amount of friction as it pertains to building these markets is substantially higher outside of crypto rails. And look, there's a ton of experimentation around this and on all sides, and happy to go into more detail about it, but that's, I think, a broad overview of that thesis.
Yeah, I mean, in other words, can we say, how everyone on Twitter, CT likes to call it hyper gambling into your wealth?
I was avoiding that. You used that word, not me, but that's you're directionally right. Yes.
Yeah, and also pair that with as you said, the trend, right? Another kind of thing to pair it is the wealth transfer that's going to happen to all the millennials. I think, I don't know, $20 trillion or something. I don't know. I don't have the exact figure, but they're not going to use that and go and buy, your regular assets. They're going to try to get into these different asset classes. We don't know it's crypto. We always think it's crypto, but I mean, it can be other markets as well that are powered by crypto rails. And also, how do you think this will impact the creator economy? We've seen in crypto itself, we have Thread Guy and we have all these creators that kind of, uniquely are positioned with their audience where it's completely different to your regular YouTuber or TikToker. How do you think the creators kind of play a role in entertainment finance?
Yeah, I'm happy to kick it off. I think we've had these ideas. I think social tokens have been sort of like this concept that have been sort of this white whale across the consumer app, discussions in crypto for a very long time. The problem with that structure is that it just has too high of a vol. I can't name a single creator token that has looked exact, that hasn't had a chart that looks like that euthanasia coaster, just goes all the way up and then essentially creators very, very, very quickly. That doesn't mean that creator financing of crypto rails is dead. I've seen certain agencies that are, for instance, lending cash against future receivables for content creators. And I've seen just sort of the core principle of buying an asset and getting a piece of status or specialized access to a creator. I've seen that working in a bunch of different instantiations. And so this idea that you can use crypto to create a new business model for media is, I think there's something really profoundly true in that sentence. I don't think I know exactly what form factor that will take or what that looks like. Because I'm sure you've seen things like Farcaster and Paragraph and like the nth NFT video marketplace come and go, and I think all that experimentation was very important to try and understand what doesn't work. And I think it's very important now that we still have a ton of founders experimenting to figure out exactly what does work, right? Because I'm not convinced that Substack and YouTube and TikTok are the only business models for media. Like, I'm not convinced that ads are like the end all and be all for media distribution. I think they are phenomenal. I think advertising is like one of the best business models ever made in history. But I think that the fact that you are seeing so much content, so much attention on the internet, there will at some point need to be a narrowing of that, and people will use crypto, just the core properties of crypto, to create markets and move money around to create new business models as a creator. And I think we're continuing to see that experimentation out there.
Yeah, I think I wrote an article about this week. I think we'll see like the affiliate and referral model die out. Like right now, KOLs can only share like Bybit links, Binance links, Coinbase links. But what you'll see is, imagine like Gainsey having his own market on like XYZ happen, and it's like a long tail prediction market for his audience, or like a sports bettor having like their own market on like a UFC fight that they're really interested in. There's a lot of stuff on, and we'll get to Hyperliquid in a minute, but HIP3 also enables you to create your own perp markets. I think maybe creators would be interested in doing stuff like that. Similar to how we saw like KSI, Mr. Beast, all these guys create their own sort of products. We'll see online creators also try to create their own markets and sort of have more upside rather than running the affiliate model. In the interest of time, I do want to move this along. Spencer, I do want to ask you about the design space value accrual. I think this is like something that the entire CT space has been going back and forth on. We've only seen like buybacks, be explored. There's a lot of chatter. A lot of people had thoughts against it. The MetaDAO stuff happened. What are things that you guys are exploring with teams at the fund right now for this particular problem?
Yeah, it's a timely question because I think, in bear markets, correlations tend to go to 1. And it makes everyone rethink from first principles whether or not the value capture mechanisms are actually working. Because, if two products with, one generating 10x the amount of revenue are trading at the same price and they're going down in lockstep, like, are our value capture mechanisms actually working? So it is a timely discussion to have. I'd say like value capture for tokens is a topic that we've been thinking about basically since the inception of the firm in 2017. I actually think one of our most seminal pieces we ever published was, I think it was December of 2017, called Understanding Token Velocity. And so like, this is obviously a topic that we're extremely passionate about. I'd say we have 3, I'll call them like unique views about value capture, not for L1 specifically, but more for app layer tokens. So the first one is a blog post that I wrote probably at this point 3 or 4 years ago now, which is called DeFi Protocols Don't Capture Value, DeFi DAOs Manage Risk. And basically the claim that I make in that paper is the only way DeFi tokens can actually capture, fee revenue is if they manage some sort of risk in the system. If the token, doesn't actually backstop any risk, then really what it is just a fee extraction layer. And I think the easiest example, the easiest comparison to look at is like Uni versus Aave, right? Uni, like every swap that happens, there's no fundamental risk that's happening because everything just happens atomically. And really the only risk is smart contract. Whereas in Aave, there's obviously always a risk that the value of whatever collateral falls, and then there's some sort of bankruptcy in the system if a liquidation doesn't happen in a timely manner. And so Aave token holders are really like the first level backstop in that system. And so the higher the price of Aave, or really the larger the market cap of Aave, the more safe the system is for lenders. And so in order for, in order to actually get them to backstop the system, you need to compensate them. And so they deserve to actually generate revenue. So that's kind of model number 1, which says that, DeFi protocols that manage risk should be able to capture value, while those that don't should not. The second one, which we wrote about very recently, is something that we call application controlled execution value capture. And basically what that says at a high level is, if you guys have been following what's happening on Solana, everyone's talking about application controlled execution, otherwise known as ACE. And basically the idea is applications get to control the transaction ordering specifically for user actions that happen on their protocol. The cool thing that this allows you to do is there's a lot of economically valuable transactions that happen in DeFi protocols, economically valuable transactions that happen where priority in the block actually matters. So the most obvious ones are like liquidations and, being the first to bid on something like pump.fun. And so our idea is, these DeFi protocols can basically allow users who stake their tokens to get first look at liquidations or be first on the bonding curve for a launch pad, or, if it's an RFQ system, get last look as a market maker. So there's this vast, underexplored design space specifically for protocols that are planning to implement ACE that we think can help their tokens capture value. The last one I'll highlight is this hasn't really been tried at any meaningful scale yet, but I still think there's an interesting design space around what we call it long-term staking, and we applied it to L1s, but this really works for any protocol where users basically agree to lock up their tokens for some duration, and that gives them some sort of super linear claim on the cash flows that the protocol generates, right? So if a DeFi protocol is generating $100 million a year, 50% of the tokens are staked for over a year and 50% of the tokens are not staked. Maybe the tokens that are staked get 80% of the cash flows, whereas the ones that aren't staked get 20%. I think we're finally to the point where we're getting regulatory clarity about being able to pay out token holders rather than just doing buybacks. So I think that is also another interesting design that's generally been underexplored. I will say the last thing though, I think buybacks are actually very good when done in a creative way, right? You shouldn't be buying back your tokens at 100x price to earnings. But when the token is valued fairly relative to comps and on an absolute basis, I think they're extremely value accretive, and the industry shouldn't just dismiss it because tokens are down right now.
100%. And talking about buybacks, Hyperliquid, I think has bought over $1 billion, and everyone kind of, I think there are two sides to this, where one argues that they should not buy back every day. They should buy back when it's not, should not be, there should be a discretionary kind of way. But I think Jeff has kind of argued against it, where kind of both cases. But you guys have positions in Hyperliquid, and you've mentioned in the financial globalization kind of theme, where everyone needs access to these markets that not everyone, FX, derivatives, options, and all of this. And Hype is one of the kind of standout protocol right now, where with HIP3 they're kind of enabling all these new markets. What are your thoughts on House of All Finance, and in general, what are your thoughts on Hyperliquid right now?
Yeah, I'll start with the first part of that, which is the discretionary buybacks versus programmatic. I don't necessarily think there's a huge difference per se, as long as you can prove to the community that you're willing to do it on a somewhat frequent basis. I do think generally, if you're doing it discretionarily, that kind of implies that you're playing hedge fund and you have some view on where the token's going to go in the short term, which to me doesn't make a ton of sense. But at the end of the day, I don't think it actually matters that much. To Hyperliquid, I guess more broadly, our view, and we actually wrote about this 4 or 5 years ago in a post, I think it's called Trade-offs in the Derivative Deck Space. But our view is every asset class should be global, permissionless, accessible, and tradable basically 24/7. And it doesn't really exist in any meaningful sense today, right? In TradFi, if I want exposure to FX or gold or equities or crypto, or even private credit for that matter, I probably need 5 different accounts with various isolated margin requirements. It's extremely capital inefficient, and most of the world can't even access a lot of those markets. DeFi historically has had similar problems, which is, capital has been fragmented across protocols, chains, There's no cross margining really across different protocols. So like if you have one options protocol here and another, perps protocol here, they don't really talk to each other. And up until Hyperliquid existed, there wasn't really any super protocol that was basically bundling all of these financial products and asset classes into one specific product where you'll be able to cross margin everything. With portfolio margin coming on Hyperliquid, our view is that retail is and HIP3, retail is basically going to be able to trade any asset anywhere in the world 24/7 in a completely cross margin way. On HIP3, I think, when silver's obviously been very successful. I think like in December, what HIP3 volumes were like 3% of overall Hyperliquid volume. And today, I think the last time I looked, it was like 23%. So HIP3 is obviously working, and there's just a few asset classes right now. I think obviously that over time that's going to grow. We're also obviously watching HIP4 closely, and we're excited about the opportunity for prediction markets and options on Hyperliquid. So it does feel like the end game for crypto is, one global venue where anyone can trade anything. And right now, Hyperliquid is obviously in pole position to be that venue. So yes, I'm very bullish if you can't tell.
Shayon, any additional thoughts?
No, I think that covered it.
Yeah. Shayon, I do want to ask you, I know, we could talk about Hyperliquid as much as we want, but, limited by time, I do want to move it along and talk about DePin for a bit. I've been following your Twitter for a while now. It feels like DePin is probably one of the spaces where you spend a lot of your time, and as you said, you have a lot of interest in. Do you think we'll see DePin come back, similar to DeFi? Also, we talked to Sal and Mahesh a lot from the EV3 Ventures guys. We have them on the pod a lot, so a lot of our listeners are very interested in the DePin space. Love to get your thoughts.
Yeah, look, I think DePin is obviously very close to my heart. I think this is one of the examples. It's one of those examples that I was talking about earlier, where it's really founder-led, right? Like, I don't think we would have thought of this as a category if we hadn't met Amir back in 2019 and figured out that you can, take this permissionless capital markets rails and use it to coordinate infrastructure in the way that they've kind of demonstrated is a business model that is sustainable and one that works, right? I think those guys are on a $25 million run rate at the moment, and it's been a long journey, right? But I think anyone who looks at the core capital formation mechanism, the underlying businesses that are powered by the fact that you can, essentially use this form of financial alchemy to turn all of your capex into opex on an ongoing basis, and essentially bootstrap all of these physical resources all around the world, in at the drop of a hat, really fully permissionlessly. I think the core principle of DePins and other instantiations of it, where the actual contribution of labor is not specifically putting up hardware, but performing actions, which is kind of an upcoming blog post that I have in the works called Internet Labor Markets. I think that core capital formation mechanism is truer today than it's ever been. And if you look at things like Helium or GeoNet or Grass or any of these companies, the underlying businesses are fully uncorrelated revenue engines from crypto, which means they're all throwing off a ton of cash through enterprise contracts with all of the basic things that compound in those relationships. So things like trust and SLAs and uptime and all of these core underlying aspects are truer than they've ever been. And I think where we're at with DePins at this moment, which is I think a reflection of where the capital markets sit across all assets. We're in a moment where I think the core structural problems are the market doesn't really understand how to price these assets. The market doesn't fully appreciate what the incentive structure means, which is to say, like, you might see too many emissions and not enough burns, and that sort of distorts the market or the perception of the ownability of the asset. And I'd say the last point is that the liquidity around these names is frankly just like not there, right? And so every single time that you look at one of these names, you're sort of constrained by the fact that it's not trading enough size. And I think there are very clear prescriptions to each of these problems. I think the question of, if you look at the marginal person that has a phantom wallet, or frankly, even the marginal liquid fund, they have spent all of their time understanding and underwriting core financial primitives and valuing these assets based on how they perceive them. If you show up to any one of these people and say, hey, here's an MVNO-MNO hybrid with a completely superior margin structure and contribution margin kind of through the roof, you kind of have more questions around kind of how to value this thing than answers, right? And so I'd say the three things that I see as precursors to a renaissance among DePins are awareness, and improvement to kind of just the core incentive design, which is like figuring out how to do emissions in a way that is consistent with, appetite for capital markets. And lastly, improving liquidity infrastructure, which is figuring out how to do burns, and just like creating the right conditions to source liquidity on these things. And I think this is only a matter of time.
100%. I think in our last conversation with Sal and team, we've kind of learned that the supply side of stuff has been kind of getting better and better. And there are a lot more, the unsustainability part of DePin has been improving. And I think many teams have taken really good decisions regarding like Helium, regarding the buybacks, it was not really helping them in that much significantly, but super cool developments happening. And I'm definitely bullish as well, along with, the other themes that we discussed. But I have like a high level question for, I think this can apply to everyone, the community, builders, everyone in crypto. So we've been through bear market before. You guys have seen it more than us, ups and downs. But for some reason, this kind of feels different. I don't know why. I've been in since 2020. I don't know why this feels different, and people are pivoting away from crypto and they're going into AI. That kind of talent drain is also happening. As someone who's in the frontiers of tech, and you see before some of these things kind of spreads across the space, do you have any kind of words of advice or encouragement for like every participant in the space to stay in crypto and kind of stick it through all these ups and downs?
Yeah, happy to start on this one. I think in previous bear markets, there was always a scapegoat or boogeyman cause for the bear market, right? Like, Mt. Gox happened, and then 2017, like people raised a ton of money in ETH based on kind of vaporware. 2020, we had like the credit crunch, and then Luna, and then FTX. And so there was a pretty identifiable catalyst in every previous bear market. Whereas in this one, there's not really like, there's some rumors about like the Hong Kong fund who was running like the option strategy on IBIT blowing up. And but everything kind of feels a bit more macro, and nothing that the crypto industry did to itself. What I'll generally say is, the opportunity set in the industry is like still massive, right? DeFi, payments, DePin, all of this stuff is working. They're, in our view, multi-trillion-dollar categories. And during bear markets, the tourists leave, and that leaves a huge gap for people who actually want to build for the long term. Honestly, like for us as crypto native investors, bear markets are when we get the most excited. I don't have the data on this, but I would guess that almost every single one of the best investments we've ever made was made during bear markets. And I think there's like a self-selection process here where the people that are still building today and, will still be building in 6 months, are the people who actually believe in the industry and are not just here to make a quick buck. They're not, chasing narratives. They're not chasing, launch a token, list it on Binance, and then sell it. And that's the type of people who we want to back. And so I guess my word of advice would be, if you're a founder building right now, the investors who will fund you are the ones who are here for the long term, right? Like all the short-term narrative investors are probably gone and are chasing something else. And honestly, I don't think there's ever been a better time to launch a startup in this industry, because the fundamentals are working, and all of the investors are here, I think, for the right reasons.
Shayon, any thought, anything to add there?
Yeah, look, I think, as Spencer was saying, this is the only thing I'd add here is that with the advancements that we're seeing in AI, like the amount of friction that is required to build a company has been reduced by like several orders of magnitude. And much to I'd say if the perspective from the rest of the world is that all the founders are leaving, or the founders are more excited about other things, I can tell you that on the other side of the table, that is the opposite of what we're seeing. We're seeing founders want to use crypto primitives come from all sorts of new directions in ways that we haven't seen before. One proxy I use for this is looking at YC companies and how many crypto companies there are in each batch, as just like a general metric of how hot crypto is. And even at this moment, there are at least 3 crypto companies in the most recent batch. And 2 years ago, that number was 0 for like several periods, for like long periods of time. And so I think the combination of like the lower friction required to build a company and the fact that you can just like tap into global financial markets, inside your cursor screen, means that we're seeing so many more new founders like take so many like interesting wild swings, that I think the story on the ground is actually very different from what you're hearing. When you look at the markets, I think founders remain super excited about what they can do with these primitives. They've gotten to a point where they are mature and robust and stable, and we're seeing all kinds of people stick around and try things. And as Spencer was saying, these are the times when all the money is made, candidly. So yeah, we're extremely excited, and I think everyone should be as well.
Yeah, one thing I'll add, and Shayon made a good point about AI. I think the other thing that's generally underappreciated is, and we were kind of talking about this at the beginning, but like the infrastructure for builders specifically in a crypto native context has gotten so much better over the last 5 years that, AI aside, like the path from 0 to 1 now is just a lot easier, right? You have like embedded wallets and smart accounts and, stable coin, like liquid stable coins, compliance, better on and off ramps, better dashboards, like all of these things just make it a lot easier to ship. And so I think when you pair that with AI, it's a great time to build in crypto.
Yeah, I think that summarizes it perfectly. I think a lot of our listeners have, succumbed to price action, and this is sort of the upliftment that everyone needed, especially I needed, to sort of get through this time. I know this is probably one of the longer episodes that we've done in a very long time. Typically, we take up like 30 minutes. This has been awesome. I do want to ask one final question, Shayon, Spencer. This is probably our clickbait of the entire episode. I want to ask you, what's your most contrarian take right now?
I'll start now. I'll say that I'll caveat with I don't speak for the rest of the firm when I say this, but this is purely my take, which is I think 99.9% of tokens should not be doing buybacks, which is look, there's a small set of opportunities that map to certain types of businesses and certain capital markets conditions where buybacks make sense. But in the traditional equity markets, when you do buybacks, you're essentially telling the world one specific thing, which is, I don't have a better use of my capital than I can't produce a better rate of return on the assets that I have through growth. And so what I'm going to do is I'm going to just sort of find a way to give it back to my shareholders. And the vast majority of businesses in crypto are not at the stage that Apple is in, where you can just dividend out $1 trillion back to your shareholders because you've reached some sort of ceiling on growth. These are all extremely early stage assets, right? Like things that are in the top 200 are still very, very early stage assets. Now, there are, markets are like reflexive things. And so expectations around whether or not there are buybacks obviously impact the price. And there is a path dependency to all of these things. But I think crypto would be much healthier if this expectation wasn't there, that a Series B stage company by all accounts producing, let's call it 5, 10, $15 million of revenue, wasn't forced to shovel that back into its token holders and like to reinvest that for growth. I think that would be a much better use of capital in almost all cases. And I think the market would do better to like think of it in those terms. But yeah.
These are the type of debates we have all the time internally because I'm pro buyback.
This could have been an episode on itself, Shayon. So I feel really hurt that I can't sort of engage in this conversation. But yeah, Spencer, what's your contrarian take?
Well, it's funny that this is a contrarian take now because I feel like if we look back 7 years ago, this would not be contrarian at all. But I think tokens are absolute superpowers, and if you're a company on the fence about launching a token, you should 100% do it. I think they're probably one of the best user acquisition tools ever created. I think they open up the door to do all sorts of interesting customer acquisition related things like, even Hyperliquid's builder codes, being able to programmatically give tokens to people who refer customers to your protocol in an entirely permissionless and open way. And then, only emit rewards to people who are actually doing valuable actions. So if they're, setting up the supply side on DePin or like putting money into an LP pool, like you can do reactive compensation rather than like paying for digital ads up front and then hoping that leads to conversion. So I think tokens are absolute superpowers. And all of this negative sentiment around altcoins is unfounded and it's just emotional reaction to prices being down.
Yeah, I think it's just the sentiment of someone launching tokens for no reason. Maybe that's why it's just the sentiment. But I think broader people, everyone would agree that it kind of helps with the bootstrapping of some of the important things for the project. But yeah, Shayon, Spencer, this was awesome. Thank you so much for your time. I mean, we've almost hit an hour. Maybe in the future, we'll, as you kind of deep dive into more pieces, we'll have you on again. But yeah, thank you so much for your time.
Thank you so much, guys. Really enjoyed it.
Yeah.
Really enjoyed it.
Although our guests this week are investment partners of a registered investment advisor, any comments on industry performance are opinions and not guarantees. Nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice.